All right, let's talk about AdaptHealth. This is a company that went on an absolute spending spree, buying up hundreds of smaller businesses to become a powerhouse in home healthcare. But now they're at a critical turning point, facing a really simple but tough question. Can they actually make this giant profitable? Or is the whole thing going to collapse under the weight of its own debt?
And that's really the whole story right there. This is the question that has Wall Street completely split. Are we looking at the future of healthcare, a revolution in how we care for people at home? Or is this just a classic house of cards, built way too fast with borrowed money? Let's get right into it and break down both sides of the argument.
Okay, so first things first. To really get what AdaptHealth is all about, you have to understand the massive, and I mean massive, shifts happening in American healthcare right now. These aren't just little trends. They're more like tectonic plates moving.
It really all starts with this number, 73 million. That's the projected number of Americans who will be over 65 by 2030. Just let that sink in. It's this enormous demographic wave of people who are going to need consistent long-term care for things like diabetes, sleep apnea, you name it. And here's the kicker. They overwhelmingly want that care where they're most comfortable, in their own homes.
And it's not just a preference thing. You gotta follow the money. And that leads to the second huge tailwind here. The people who pay the bills, we're talking Medicare, private insurance companies, they are pushing, and I mean aggressively pushing, to get patient care out of these super expensive hospitals and into the home. Why? Because it's just so much cheaper. It's not a choice, it's an economic imperative.
So this is where AdaptHealth comes in. How are they set up to ride this wave? Well, just look at where their money comes from. Their whole business is built on stuff people need over and over again. Think of it like a subscription service for your health. That creates this really predictable recurring revenue stream. Nearly half of it comes from sleep health, so CPAP machines and all the supplies that go with them, which, need to be replaced all the time. The rest is rounded out with other must-have services for things like breathing issues and diabetes management.
The opportunity is obviously huge, right? But the question is, how did AdaptHealth get so big so fast to even be in a position to take advantage of it? Well, their strategy wasn't exactly slow and steady. It was more like a lightning attack.
So here was their playbook. The market for home medical equipment was basically a giant patchwork quilt of thousands of little mom-and-pop providers. AdaptHealth saw this and acted like a giant consolidator. They just went on this epic shopping spree, buying up company after company to stitch them all together into one national giant. But that kind of hypergrowth, as you can imagine, is a real double-edged sword. On one hand, yeah, they gave them this incredible nationwide scale that no one else had. But on the other hand, it left them with a mountain of debt and the absolute nightmare of trying to mash all these different companies with their different systems and cultures into one cohesive unit. And that, right there, is the central problem they're dealing with today.
Which brings us right to the present. This is their big prove-it moment. The party's over, the era of just buying growth is done. Now the hard part starts. They have to show everyone they can actually run this massive thing they've built and, turn all that size into actual, real profit.
I mean, this is the billion-dollar question, isn't it? It's one thing to build an empire, but it's another thing entirely to make it run smoothly and efficiently. So let's dive into the latest numbers and see if this big pivot from buying companies to actually running the company is working.
This number might not look like much, but 5.1% is probably one of the most important figures in their recent earnings. That's their organic growth rate. See, for years, the only way they grew was by buying another company. This number shows that the business itself, the one they've built, is finally starting to grow on its own. For anyone who was worried this was just a house of cards with no real foundation, this is a huge sign that, hey, maybe this thing actually works.
And what about that debt problem we talked about? Well, they're tackling it head-on. The company has already paid down $225 million in debt just this year. That's a really clear signal that they're serious about getting their financial house in order.
And paying down that debt has brought their net leverage ratio down to 2.68. Now, net leverage ratio is just a fancy Wall Street term for comparing your debt to your earnings. All you need to know is that lower is better, and getting that number below 3 is a really big psychological and financial milestone. The bottom line is, their financial health is improving, and that gives them the breathing room they desperately need to invest in the future.
Okay, so things are stabilizing. That's good. But to go from just surviving to actually thriving, their entire future now really comes down to successfully pulling off two enormous, potentially game-changing projects. These are the two big levers they have to pull. First,
executing on a massive new national contract, and second, finally using technology to get their sprawling operations under control.
Let's start with this contract. This is not just another customer. This is the final exam for their entire business model. I mean, landing an exclusive 5-year deal to take care of over 10 million people is incredible. But winning the deal is the easy part. The real test is executing it profitably. Can they coordinate all the supplies, the staff, the logistics across the entire country for this one partner? If they can pull this off, it proves that their massive scale is a real, undeniable advantage.
Their second big bet is on technology. You have to remember, there's still a Frankenstein's monster of hundreds of different companies, each with its own ancient software and way of doing things. The big goal here is to rip all that out and build one single technology platform for the entire company. That would let them standardize everything, so an order in Miami is handled the exact same way as one in Seattle and automate a ton of boring manual work. But the real prize? Using modern digital tools to keep patients happy and ordering supplies, which is where they make their best, highest margin money. So when you put all of this together, the huge opportunity, the scary debt, these two massive catalysts, you end up with two completely different stories for where AdaptHealth could go from here. And you better believe the market is watching every single move.
So here are the two competing narratives. The bull case is the Hollywood ending. They absolutely crush the execution of that new contract. Their tech investments start paying off by cutting costs and boosting profits, and Wall Street rewards them with a much, much higher stock price. But the bear case is just as easy to imagine. The contract becomes a logistical nightmare, growth grinds to a halt, and that huge debt pile starts to look really, really scary, especially if insurance companies decide to cut how much they pay for services, which is a constant risk in healthcare. And this chart really shows you what's at stake in black and white. You can see the stock is trading around 9 or 10 bucks. The average analyst thinks it's worth over 13, but look at that bull case. Some people think if they get this right, the stock could go to $16, maybe even higher. It just perfectly illustrates the risk and the potential reward here. It all comes down to execution. And in the end, it really does all boil down to that one simple question. The grand strategy is done, the plan is laid out for everyone to see. Now it's just a question of whether or not they can actually deliver.
All right, and before we go, just a quick but very important reminder that this explainer is just for informational purposes. It is not investment advice. Investing always involves risk, so please make sure to do your own research or talk to a licensed financial professional.